Well, I think it's working. I'll have to edit all that out and post. All right, good evening, guys. Ken at Tortoise Capital. This is the session number 4 for the book club for the foundational trading book. And we're working on session 4, 31 January 2024. We're taking a look at these pages 131 to 161, which is section 9 in the book. It's my brother's discussion of the sniper. And where we've been is we've been starting at the very top with the authors and strategy, and then a discussion of how we take notes with Cornell note-taking method, and a review of the book, organization, and the background of our community of practice. And then we drilled down into a statement and a listing of creating challenges, reference books, and inspirations that have been helpful to us in the development of our systems in the community of practice. And then last week we operationalized that in sections 5 through 8. We took a look at concept models like system, self, and market, plan, prepare, execute, assess, taking a look at things that gave us edges, um, some trading uh, concepts and building blocks, and then some of the mindset that goes into psychological preparation for the rigors and joys of trading. And then today we're going to drill down into some tactical material, taking a look at the sniper system and mindset. Um, Next week, we're going to take a look at another tactical system, the Kata 2 challenge. Um, and in session 6, we're going to look at a variety of trading tools that are in the daily and weekend report that we use as components of planning and preparing and trading. Section 12 is really a giant list of many components. These in section or in session 6 are going to be pieces and parts of the daily trading plan. These have more to do with a variety of procedures and indicators and whatnot. Uh, and that'll take 3 weeks to get through that. Session 10, we're going to look at 10 featured traders who are all using our various systems in some combination in a way that is well suited just for them, to show that what we've got is an adaptable tool set that can meet many different objectives. In session 11, we're going to take a look at some possible ways forward. That's one where after you listen to the featured traders, you may resonate with one of them directly and have a clear path forward. But if it's not clear or you want to check your own oil, um, send me an email to review, and then I'll talk about in section 11, answering those questions and taking a look at your self-study plans, and really we'll use that to clean up any final uh, Q&A in session 12 and review the other materials that we have available if you find this stuff resonates. So that's a quick look at the path ahead. Alrighty. Um, so I'm going to talk about the sniper. That little sniper icon in the upper left-hand corner. It's from some original artwork that I got from a wounded warrior who is now becoming quite a remarkable artist. And it's almost a three-dimensional picture. He's got um, really thick use of almost like paint and clay, and I didn't really go too far into how he did it, but it's got a three-dimensional effect, very thick paint, or a almost or a smooth statuary, but it's just absolutely fascinating. And it really captures the essence of the sniper. And I'll show you a picture of him later. But what I'm going to do is go through the note sheet and then come back to this process model uh, to illustrate some various points. So you may find that to be a little bit easier to get. So we'll try it both ways. So here we are on the Cornell note sheet. This is 31st of January, session 4 in the book club meetup on the book Foundational Trading. We're looking at pages 131 to 161, which is section 9, and then the sniper material. Um, I want to start with some keywords and concepts first. The first one is the idea of a compound critical state. So, as you may remember from last week, or you're hearing for the first time, a critical state is one in which price has moved into a certain condition. And ordinarily, it means range compression as well. Because what we're saying is that we don't know which way that that thing can go, but it actually is poised so that there is a large, reasonable move that's available from the breakout if we treat the whatever the setup box looks like, and we've picked a couple price levels that give us a breach this way as an entry and a breach that way as an entry short. And so this piece in the middle is the uncertainty zone, and we might look at that as a risk, an execution risk, because either one of those lines, when they get breached from our frame, is an indication that price is starting to move in that direction. And so the idea of a critical state is that on one time frame, we can see that it has moved into that condition. And now what we have is, as a critical state, a higher than normal probability of a larger than normal move in either direction in a shorter than normal period of time. So we're really looking for like a compression and then a breakout towards some reasonable price targets in both directions. And by virtue of the compression of the range, then the amount of risk we have to take compared to the reward is small risk, big reward. And because of the range compression, this breakout acts like a surprise. And so you get a burst of a movement in a shorter than a normal time it would take to cover that distance. So you're getting a running of the bulls. Uh, and and that's what we mean by a critical state. It's combining potential volatility, price location, range compression, reasonable targets, and as we said last week, for this to be valid, you have to have time, will, pattern, and money available. Those are the four ingredients that give you the base criteria to have a trade. You have to have, if it's an intraday, you have to have enough time left in the day or enough time on a swing trade before the earnings announcements or whatever. You have to be in the right psychological state. You have to have a valid pattern according to the rules of the system. And you have to have risk capital available to trade at the desired position size. Now, if you have those four, it doesn't mean you must trade because you always have judgment, but you have to have all four of those in our view to be able to have a trade. So if this is a critical state, if we add a compound to that, a compound critical state means that not only, for instance, is this thing ready to break out after a compression on the 3-minute chart, but maybe if you look at the 30-minute chart and the 2-hour chart and the daily chart and the weekly chart, each one of those time frames has the price in a critical state for that time period. So if I was looking at a daily chart, maybe it's very close to a 10-day high, which has acted as resistance before. And so if price breaks out of that 10-day high, there's reason to believe that those swing traders might want to pile on as a breakout trader. Or if they don't, and that 10-day high is rejected, maybe they're looking for a return to the mean. And so that could be a swing trade in that direction. So if the daily chart is in a critical state because of its location relative to the 10-day trading range, and on the 3-minute chart, it happens to be at a local minimum or maximum, it is also overbought or oversold and is tightly compressed. Now suddenly you have multiple demographics of independent traders who are all ready to jump on that thing for reasons of their own. Now, if only one group is in a critical state, then the amount of money that they have that is normally allocated to their trade gets put in and you get a normal move based on that time frame. But if, for instance, you were lucky enough to have all of these independent time frames all in a critical state together, and then when price crosses that threshold, let's say to the bottom, now suddenly you have 5 different independent populations all looking to get short at the same time. And what you get is each one of those groups gets surprised by the extra money of the other guys that are now piling on. And this is all out of proportion to what they're used to. So they get surprised. And now fear or greed takes over. And then you get intraday tactical momentum, which can feed on itself and attract other momentum traders. And so a compound critical state is combining multiple critical states from different time periods into one tightly compressed breakout box. That's what we mean by compound critical state. What the sniper system does, which is defined on those 15 pages, is uses a set of indicators to find a critical state based on trade location compared to a look back period. So if I'm going to look at a 10-day look back period and I consider the bottom 10% to be oversold and the upper 10% to be overbought, whenever price is in the middle of that range, it's not unusual. But if it moves up into this overbought condition, now suddenly everybody who is a swing trader is on high alert because they know that this has really close to a potential breakout, which could lead to the next higher resistance level because that breakout is going to attract some new money. That new money is going to come in and create momentum that takes it to however far it's going to go. But they also know that it could actually fail here, just like it failed back here. Back here at this time, 8 days ago, maybe this thing came all the way back to the midpoint or all the way into oversold on its way back up to overbought. So all of these guys that are here know that from its recent history, if this doesn't break out, then it might just break down and it could go as low as the previous 10-day low. So now everybody that's tuned into that time frame is looking at this extreme overbought as a special abnormal condition based on a 10-day look back period. Well, what if I had a 30-day look back period and a 150-day look back period, and in each case, that price was located at an extreme? It doesn't have to be the same extreme, but as long as it's at the extreme of each look back period, all at the same time, now what I have is a rolled up compound critical state based on location. Check or hold. That's a chance for you to say, wait a minute, I don't get it or I need more. Um, at the same time, the other thing we're going to look at is volatility. And we know that most of the time things are in normal range of volatility, but sometimes they're very volatile and sometimes they are abnormally quiet. What we care about is taking a look at the 5-day volatility by taking a 5-day look back period and finding the high and the low and measuring that distance from the 5-day high to the 5-day low, and then dividing that by price. So high minus low divided by price gives you a percentage. It tells you what percentage of price is expressed in that 5-day maximum travel. So then what we're going to do to use statistics is go back 30, a total of 30 5-day periods, and we're going to measure the percentage of each one of those. And then we're going to array that from the maximum percentage of volatility down to the minimum percentage of volatility. We're going to find the average of those 30 5-day percentages, and then we're going to compute the standard deviation and create an envelope of normality. And we know that if it's more than one standard deviation greater than average, it's going to be volatile. And if it's more than one standard deviation below average, it's going to be quiet. And so what we want to emphasize is a search for things that are extremely volatile. So prices moving now like a scalded ape or a buffalo stampede, or that herd of buffalo is abnormally quiet, and when they are surprised into wakefulness, they could start a stampede right away. So what we want to do is emphasize that these two conditions of abnormal volatility, both volatile and quiet, give us the kind of compound critical states that lead to surprisingly large moves. And when you take those together, if you get location and volatility stacked up in your favor across multiple time frames, then you have all the ingredients of a compound critical state from which a larger than normal move in either direction in a shorter than normal period of time is not surprising at all. In fact, we can be prepared for it. And the fact that we are prepared for that abnormally large move that surprises all of those different populations, we're not surprised, we're prepared. And in that difference, we have a persistent edge based on psychology and professional preparation. So that's what we mean by the sniper system, more to follow. As part of that, we're going to use three different technical indicators. The RL10, which in the book is written as the moving linear regression line. The RL10 is a moving average that's based on the 10-period regression line, which looks like this. If I had 10 bars, because it's fractal and works on every time period, all I need to compute the regression line is the closing prices, and then I can construct a 10-period linear regression line, which is the best fit line for all those 10 prices. And then the endpoint of that regression line is on the 10th bar, and that predicts, or it identifies, what is the perfect price as predicted or explained as described by the line. So I can take all of that noisy 10 days worth of price data and array it as a single point. And now if I do that each day, I can start drawing those points each and every day by adding today's price and dropping the last price. And now what I get is what looks like a moving average, but it's just connecting like a snake the endpoints of each daily regression line. And that is what we use as a proxy for price. And so on any given day, if that is where the regression line predicts price should be, we treat that as the real price, and then all of the wicks of the daily prices we can treat just as noise. So if this blue dot is where the regression line was drawing And then if that's the price, we treat that as the actual price, and then we can disregard and smooth away all of these little skeletal bones, like, ribs or whatever. And what that does is gives us a way to find our way through the noise by plotting a perfect path of the regression line. Now we know the regression line isn't the current price, but we treat it as price for all of our signals and setups in order to reduce the complexity and uncertainty of volatility. It gives us a way to chart our path through dangerous waters. So the 10-period regression line, or the RL10, equals price. Now it turns out that when you use a linear regression as the basis of your moving average, it's also known as a least squares moving average, or you'll see it sometimes as a LSMA, because it uses the least squares method to calculate the regression line. That is much faster than a simple moving average, an exponential moving average, the whole moving average, the triangular moving average. It turns out that the least squares method of computing the moving average is very adaptive, very responsive. Like, it only takes 1 or 2 days of deviation to really alter the slope of that, whereas it might take 5 or 6 days of normal price changes to move the simple moving average. So that leads me into the second tool that we use, called the Dragon. What we use in the Dragon is really a buffer, and it's slower than the least squares moving average, which is faster. And what the Dragon represents is a 10-period simple moving average in the form of a Bollinger Band using 10 periods with a width of 0.5 standard deviation. So what you get in the Dragon, which we code as orange, you will see a picture of the Dragon moving up through time and space, and the center spine of that Bollinger Band, what we call the Dragon, because it looks like a water dragon flowing through time and space. Um, what you get is, at each point on the spine of the Dragon, you have, that's the value of the 10-period moving average on that day, and then plus half a standard deviation and minus half of a standard deviation, and you get an envelope. And so what the Dragon really does is just connects all of those dots. All of the highs get connected, all of the lows get connected. The spine of the Dragon becomes a simple 10-period simple moving average because of math. And because it's using 10 periods to compute that, we like to compare that to the RL10, which is also using the same 10 periods, but it is a faster moving average. And one of the things that you will see is that the RL10, which we normally draw as blue, let's say it's in a downward trend and price starts to reverse, what you'll see is price action looks like this. The RL10 is pretty close to it all of the time, and then suddenly price will start to move this way. And what you'll notice is that the overshoot, or the deviation of the RL10, gets reversed pretty quickly, and it gets right back onto the price. And when it does, the RL10, because of the way it is computing, always creates a pointy turning point. The slope is down until the slope is up. It's a rare case for the regression lines to be painted like this, where you have some moment where the slope is zero. It's not impossible, but it's maybe 1% of the time you see that. So for our purposes, what's very helpful is that when the price reverse happens, that RL10 moves to a sharp point. And what's important about that is when we use the parabolic stop and reverse as our trailing stop, when that price is moving down, the PSAR is like this. And then when you get enough price reversal, when the PSAR flips and now becomes upward sloping, it is drawn exactly to the level where the RL10 reversed. Now that's extremely important because that turning point in the RL10 is the statistically significant lowest low of that swing on any time frame. And so that acts as mathematically significant support. And so when the PSAR flips from here down to here, because we are using the value of the RL10 dots to compute the PSAR, you get the PSAR being drawn exactly where the RL10 reversed, and now we have absolute precision on that point to act as the support level. Now, why is that significant? Well, it's significant because the price bar that actually created the lowest low is always going to have the lowest low at the extreme. Now, we don't know how much volume was transacted there, but when you see the RL10 being drawn, and it in blue, and you see it reverse, what you realize is that there is a distance between the absolute lowest low of the price and the turning point in the RL10. Now, why is that significant? Because in every pattern that we trade, we can use the statistically significant price level of the bottom of the RL10 as our stop. And what that does is give us a little buffer so that if we were trying to go long in here, like with the supported spring crossing, but that thing failed, when it fails down through this level, we can change our orientation to the short side because we know that the statistically significant support level was breached. And it's normal for price to be flow in that little region. But if it breaches the low that was established by the absolutely lowest price of the bottom tick, everybody that got long along with us is putting their stops below that. And so we can be short when our stop is violated and it drifts down, and when it breaches this level, you get an explosion of price movement to the downside when all of those initial stops are hit that we're trying to go long. And so it's not unusual to see a furious burst of activity once the swing low based on price is violated. This little statistical mathematical edge is so important that I'm going to just say it again. It is so important that it leads to the collapsing dragon pattern, which is my number one favorite pattern on every time frame I trade. From 1 minute to 1 month chart and everything in between, the collapsing dragon represents a failure of a reversal. It goes through our regression line 10 price limit and we get short. And then, not unusually, there's an explosive move to the downside. If you don't learn anything else from that book, learn that, The Collapsing Dragon, and the mathematical basis for it is not written about anywhere else that I know of. Now, we said the RL10 is the price, and it uses a 10 period, and we know the dragon, which is in orange, is slow, and it's a 10 period Bollinger Band, plus or minus 1/2. So the dragon is this thick region of price action, And what you'll see is now we want to take a look at the relationship between the 10-period simple moving average of the dragon and the 10-period regression line, which is also using the same 10 periods and its sharp reversal. So one of the things that we notice is that after the RL10 reverses at a point, it will enter the dragon, which is starting to reverse. It'll cross the spine. That's the RL10 crossing the 10 SMA. And then the RL10 will leave the dragon, and we call that regression line crossing the dragon, or RLXD. And this is an important signal for entries into the supported spring crossing, which is going to be one of the patterns that the sniper uses. So this gives us a way to calibrate the shift from a downside trade where we'd like to be short. As long as the slope of the RL10 is down, uh, I'm hoping, or I'm supposed to be short if I had a good signal up here. And then when I get the reversal, I'm on alert. And now we're going to use the baby dragon as our next indicator, which we color in purple. And he's simply the baby dragon, baby D, is a simple moving average 3 of the dragon. So it's a simple moving average 3 of the dragon. So as long as price is down, the baby dragon is tracking it and lagging. And when the RL10 reverses, it'll cross the baby dragon quickly, and then it will reverse quickly. And so now when we take a look at the warning lights about when to change our orientation, we have these alerts. We have the change in slope of the RL10. We have the crossing of the baby dragon. We have the entry of the dragon, the crossing of the spine, and the leaving of the dragon. Each one of those is like the warning lights on a traffic light that tells you, hey, this uninterrupted downward price movement is starting to shift to the upside. Now, this entire period is filled with chaos and uncertainty and volatility and ambiguity. That is what happens at major turning points. When price is in a state of transition, you have an increase in volatility, uncertainty, complexity, and ambiguity, or what we in the Army would call VUCA. So it's not unusual to see people in a panic about what to do. Well, that's where these statistically driven indicators and each of those checkpoints allow us to fine tune our decision making and gear it towards measurable mathematical moments that allow us to develop rules that can be tested. And for our purposes, what we find is that when the RL10 crosses the dragon to the other side, the RLXD, dude, you better have changed your bias to the other side. But at the same time, you expect that trade to fail, and the trade you really want is the failure below the previous belly of the RL10 where it changed. Because if all of this transitional price action to the upside fails, you're going to get the best trade, which is the collapsing dragon. So, Ken, why don't you just trade the collapsing dragon? Well, I always trade the collapsing dragon, but there are so many good opportunities on the upside that my third favorite pattern, the supported spring crossing, is worth trading. Because when you get a harsh winter that reverses, and then you get a supported spring crossing to get long, sometimes that works. And if you get a successful trade that exits, and then price continues, but now reverses, and now we're looking at the RL10 here. The RL10 was up, so we got long after this turning point. We cashed a winning trade, and the retracement did not go lower than the previous low of the RL10, we now have what we call a Kata 2, which is our second favorite most pattern, because after a very harsh winter, it's not unusual to see price moving up in a series of smaller measured steps, and you get a Kata 2 at every one of those little pullbacks, and we have the stats and the setups on that. So as long as you have rising lows, you can continue to take those Kata 2s until such time as the pullback goes below the previous low, and now that whole run is done, and now you shift to a different target. So taken together, the sniper system is going to describe how we are going to find good setups using location and volatility, how we are going to prepare the trade frames in a standard way for mathematical execution, and then how we're actually going to trade it with a series of patterns, because the pattern we pick is going to be a function of the way price behaves. So we're going to prepare all of the symbols that meet our setup criteria, and they're all going to be ready to trade. They're in the sniper's box. And when they leave the box, according to the rules of the pattern, we simply follow the rules on any one of the patterns that we are trained on, and we take the shot. So everything that makes it to the prep list is in a compound critical state and is perfectly ready to trade. And when price action moves in our favor, we take the shot based on the particular pattern that fires intraday. And we do that every day with no overnight risk. Lather, rinse, and repeat. That is the essence of the sniper system. I'm going to show you some better flashcards, but I wanted you to feel what it's like to hear the words, see the drawing, internalize the process through your feelings and your direct sensory experience. So I just described the sniper concept. We say here why we have no directional bias on page 131. We explain the compound critical state on page 137. The compound critical state, when you're stacking up you're stacking up critical states from multiple time frames, why the statistical and visual graphic approach gives us a robust edge, because we are prepared and we're not afraid of math, and the rules that allow us to use the combination of a supported spring crossing, and if it works, into the Kata 2, and if it fails, into the collapsing dragon, gives us an integrated trade strategy at every compound critical state, which can take symbols that are in a tightly compressed risk box, and then we can follow price. If it goes long, we're taking the SSC and the Kata 2s. And if it fails, or fails immediately, or if the SSC fails, then we're into the collapsing dragon. So we have effective strategies for price breaking out in either direction. And because the risk box is small and the reward is large, we can trade it with false breakouts a couple times and have the winning trades more than pay for the losing trades. The sniper system indicators, pages 143 and 144, is where we describe in words and pictures all the stuff I just said. And then we use a charting layout that looks just like this, very simplified indicators. Now you notice we're not using candlesticks, we're using very thin bars, because what we care about is not the wicks, but we're looking at the 10-period regression line as the price, and I'm going to cover that with that big, thick blue line. That's the price we care about. Look how smooth that is. And every place there's a PSAR flip after a harsh winter is a place where a sniper trade to the upside is possible. And you have a PSAR flip that is significant here, and you can get that trade. And if this belly of the RL10 had failed, which was where the initial risk is, if this had not gone up, but instead had failed through here, then we would be taking a collapsing dragon to the downside. And then our estimate of that move is we take the size of the previous sell-off, which is what created the harsh winter in the first place, and then we just double that. We say it would not be surprising if it went that same level. So now we can rapidly and visually estimate the size of the move to the downside. The move to the upside is computed by finding the last peak of the RL10 and saying that that statistically significant price, we're not allowed to be surprised if after this PSAR flip, we're not allowed to be surprised if price breaks out and returns to this price level. And then from here, if the buyers are persuaded that this was actually a turning point, then we can say the size of this move could be the size of the next move. And so if it is successful on a test of the previous resistance, we say target 2 is going to be that same distance up, and almost to the penny, you get that move. And it turns out that the size of this risk box is small compared to the move back to target 1 and target 2. And so this turned out to be a 4-to-1 reward to risk box if a supported spring crossing works. But what we actually would hope for is a failure of that, because we're going to get a 5-to-1 probably to the downside. So all we care about is identifying these compound critical states where range is compressed and a big move in either direction is possible. And that's what math will do for you. Systems versus psychology on 139, we talk about psychology. This strategy requires trust and confidence in practice with math, and then excellent execution without thinking too much. So you got to be trained on it, and you have to follow your training, and you have to trade it at a level of risk that allows you to execute without overthinking it. What we want to do is all our thinking in the plan and the prepare, so that in the execute phase, we don't have to think. And that gives us an edge, because normal humans are doing all of their thinking and worrying and emotional based suffering during execution, but we're not, because we do all the work in planning and preparing so that in execution we can execute by battle drill instantly, without fear, with professional pride and competence and trust in our tools and position sizing to protect us. And then what that lets us do is gather the data from standard work of trading in this way to then assess to determine how we might want to adjust our rules for planning, preparing, and executing. When it comes to managing losing streaks, we also know what the normal statistics of our performance looks like. And in the book, my brother described a day when he was personally coaching people through that, and he experienced 6 wins in a row, and then 10 losses in a row, and then 8 wins in a row. And the amount of money that he made on the 6 wins was bigger than the 10 losses. And then the money that he made on the 8 follow-on wins was also bigger than the 10 losses because he was using proper management and risk control and then letting his winners run on a favorable trade. So that's also part of the intersection of self psychology and system performance. And what we're doing is learning to trade ruthlessly, not emotion free, which is a really important part of his section, because the emotions that we're generating are what connects us to the feelings of the herd. And we use that energy to give us the will to take action. So we respect the emotions. We just don't let emotional children and monkeys drive the family car. We let them feel the emotions, but we know how to drive the car as an adult. So don't suppress the emotions, don't control the emotions, as it turns out you can't, but you got to be able to feel them in a way that is productive and rewarding so that you don't burn out your neural circuitry. The system rules that are covered in the book and in here are summarized there. Every one of those patterns has a specific set of rules that we cover in our workshops, but I've given you enough information on this briefing and on the flashcards that you could recreate it on your own if you wanted to do the work. Then what we do is we look at markets in which the individual targets, like large caps and ETFs and Forex, each one of those markets has candidate symbols that are liquid and volatile enough that we can trade in this manner because they reliably move larger than the other members of their population. So we identify really good targets in each of those subpopulations or submarkets, and then we use our psychology to apply the system into markets and targets that are appropriate. The best use of the sniper is intraday, but it can also, and it can be traded on the 3-minute bars. It can also be traded on the 30-minute bars so that you can, in the 13 30-minute chunks of every trading day, you can have plenty of price movement that lets you comfortably trade the ups and downs on 30-minute bars and play the swings. On the 3-minute bars, you can make a lot of money on the individual swings, but you can also expand that rule set to use 2-hour bars, daily bars, 3-day bars, weekly bars, 9-day bars, and monthly bars. And you can use the same patterns, but what you may do is a different set of rules to find critical states and volatility once you get out past once you get past the daily. But we run the reports and numbers on the daily because when it's in a compound critical state off the daily, that means it's going to be a good intraday or short-term swing on the 2-hour, 1-hour, 30-minute, all the way down to the 3-minute. So the daily report, the daily screening, is what allows you to pick the trades for tomorrow and prepare them when the market is closed, and then wait until after the gap to determine which ones you want to trade. So you're not getting hit with the gap at all. Well, it turns out that the symbols that are good trading candidates on the daily that work good for intraday can also be used to start swing trading. And if the trade keeps working, you can actually widen your aperture and go to the longer time frames and manage the trades according to reasonable exit strategies. And so from the daily chart, you can go in either or both directions. And now you can create a meta trading system using common patterns that are fractal in nature with a common set of targets that trade very well intraday and on swing trades. That is very efficient. Griff's note to himself is to make sure that he has his own personal checklist to make sure that he understands what all the patterns and criteria are so that he can adapt the same strategies he teaches in the kata 2 for the other patterns that are contained inside the sniper system. The other thing I want to point out is the psychological elements that my brother, a career healthcare provider for trauma victims, uh, hospice patients, and emergency room patients and their families, he understands the emotional impact of critical states better than anybody. And as a healer, he understands what it takes to prepare you to be resilient. So he's got a lot of ideas expressed in that book on robustness and simplicity and how to build the habits of mind that allow you to build the emotional bank account for your psychology that allows you to put up with the stress that we would associate with rapid trading. That's everything I want to cover from the Cornell note sheet. What I want to show you is the idea of the sniper in a visual way. Now, what I said about uh, the sniper and the way we set him up on the previous section is contained here. So what we're really going to do is talk about how you get setups, how you prepare the symbols that meet your setup criteria, and then how you trade them in three different categories in priority and in sequence. What happens if something that meets one of your five setups and then is standard framed according to, we've got analysis that says here's the correct position size it should be traded at, what the reward to risk is based on standard assessment, how we're going to stock it, how we're going to enter it, how we get to no lose plus dinner for two to manage our initial risk, how we're then going to manage the stops on a successful trade, how we're going to exit, and if we're going to stop and reverse, or if we exit, are we going to re-enter if it comes back in our direction? And under what conditions would we take a second position? All of these are standard work that we do when we've identified something that is in a compound critical state, whether that was because it was oversold or overbought, or is so tightly compressed and in the middle of its look back period that it has met the criteria for a compound critical state based on both location and volatility. And then when the market opens the next day, we take all of the things that met our sniper criteria, and there are five different setups that we discuss. And I'm going to talk about Godzilla the most because he is king of the monsters. We take everything that meets any of those criteria, we put standard work on it to frame it so that we understand that if it breaks out from this risk box, we know what the reasonable target to the upside and downside are. And if that yesterday's range looks like our initial risk, we're looking for things that have better than 2 to 1 in both directions, and that meets the criteria for a compound critical state. What we like to do is take everything that's on that prepared list and put it on a watch list. And when the market opens, we're going to sort it by the size of the gap percentage. And we are going to prefer everything that had the biggest adverse gap and or the largest favorable gap, because those two abnormal conditions are telling us things that are in play to the upside and running amok, and things that are in play to the downside and running amok. And we're going to trade those on 3-minute bars using an entry technique that is either the hybrid frog, the opening range 3, or the WMB3 technique for entry, which we teach. And after we've done that, usually about 45 minutes to an hour in, everything that actually sold off partially during the day that meets our criteria for a harsh winter that has started to reverse according to the RL10 is now a candidate for this little three-part harmony of an SSC, and if that works, pot of twos all the way up to the targets. It first has to get through yesterday's high, but if it does, we've seen leg one, and then that could lead to leg two and a massively good trade. But if it fails, then we can execute the collapsing dragon. Now, we will trade those patterns until the movement harmonizes into a sideways quiet channel that has become so abnormally compressed that we now have a Z3 pinch where the three sigma Bollinger Bands have compressed to a very tight, mathematically defined wrist box. And now we can take that as a Z3 pinch, a breakout in either direction, or it could stay pinched for so long that all four regression lines that we track, the 10, the 30, the 90, and the 270, have all also moved inside that wrist box. And that super pinch is like the best little acorn you ever saw, from which the explosive moves on the outside gives you the great big oak tree or it falls off a cliff. That little super pinch is the rarest of our patterns, but when they hit, it is my highest priority for trading after the collapsing dragon, simply because of the potential that is implied by the incredible um, compression. So what we're going to do on our radar screen is take a look with the sniper of three look back periods. A 10-day look back, which is our tactical time frame, a 30-day look back, which is the basis of our swing trades and what I think of as operational or midterm times, and a 30-week or 150-day trading look back, which is long-term. This is long-term swing and position trading, and this is regular swing trading, and the combination of 10-day and a little bit of 30-day can give you short-term swing trading plus day trading. So depending on which time frame I want to look at, I can look for these patterns in a combination of two of the three, but I'm always looking at the 30-day. If I'm looking for longer term, I add the 150-day look back or the short term. Now, what I'm going to do is say that each one of these time frames has a look back period that has the highest high and the lowest low. And the overbought condition is the top 10% of that look back period, and the oversold is the bottom 10% of that look back period. And then what I call the fence sitter is this sneaky midpoint. And it turns out that if things are right exactly in the middle of that look back period, and you use that as your risk box, that middle 10%, you can actually frame a 3-to-1 trade from the breakout up to the overbought or oversold condition. So you can actually trade inside the look back period if it's sitting on the fence and it is quiet volatility. So we run the analysis on the 150-day look back, the 30-day look back, and the 10-day look back. And for the example of the Godzilla, we say we're looking for a symbol that has become oversold dramatically on his 150-day look back. So it's on the 150-day look back, it's in region C. It's oversold. It's horrible, terrible, bad, not good. That's how bad that is. And we look on the midterm, the 30-day look back, it must also be dramatically oversold. And now this is where it gets interesting. On the short term, I'm willing to accept a critical location of either oversold or overbought. Because now what we have is if it was oversold, 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 as soon as that thing collapses, it's bound for glory. No, the other way. It's bound for not glory. It's going to the bad place. And we like that because that's going to be usually a collapsing dragon, which is massively good. The Godzilla requires that the last 5 days that are extremely volatile. So what that tells you is it's already in a state of enragement. It's already starting to move. And that means the breakout is going to follow through with momentum in either way. Now, the trick on Godzilla is that you get oversold, oversold, and now I can accept either oversold or overbought because from those two extreme conditions, there was something that made it move aggressively to here or it terminated down here, but it was a large 5 day move. And now the breakout from either one of those extreme conditions can be huge. So I have no directional bias, but I am following price as it moves with volatility. So when I find all of the symbols that I like that meet the Godzilla, and I start with about 30 large cap companies and certain select mid cap companies that are very narrowly focused, like Alcoa, Devon Energy, International Paper, plus all the components of the Dow 30, and about 30 different exchange traded funds that are routinely liquid and volatile and least correlated, like the SPY, the Russell Small Cap, Mexico, Brazil, and all 30 of the ETF 30. I now have 60 candidates, and I run them all through this criteria for long-term, mid-term, and short-term for price location and the volatility stats of the last 5 days. And anything that comes out of that 60 that meets a Godzilla gets labeled as a Godzilla setup. And then I'm going to move to standard work and I'm going to plan out my the dollars that I'm going to risk, what my initial risk is going to be, compute my reward to risk to see if it to ensure it meets the criteria, rehearse and set up my plan to stalk, enter, manage the trade, manage all the stops, decide what my exit rules are going to be, and look at places where I would probably have to stop and reverse at support and resistance, decide if I'm going to re-enter, and where I might want to put my re-entry. So I build a standard trade frame for every symbol that meets the Godzilla criteria and every symbol that meets the other criterias, because each of those is looking for price action and setups in different trade locations and different kinds of volatility, whether it's super volatile or super quiet. But each one of those represents a different psychological category of radioactive setups that I then prepare in a standard way. And then anything on that list, regardless of the source of the setup, I'm ready to trade the next day. And the first thing that I'm going to look at is that big gap, and I'm going to prioritize the ones that are hugely up or hugely down on 3-minute charts. And then after usually 30 to 45 minutes, whichever ones have hit the harsh winter and have started to reverse with the RL10 and hopefully have crossed the baby dragon. That should be purple because that's the color we use for the baby dragon. Come on, Kenny. And when it has crossed the dragon, which is was normally right here, I know that eventually that RL10 is going to reverse and cross through here. And now I'm going to have an entry right there. And I know that my standard risk box is going to be drawn, that when that happens is the same time that the PSAR is going to flip from downward trend to upward trend because of math, because we're using the price indicators of the regression line points to compute the regression of the PSARs. So I now know my standard risk box is going to look like this. And then whatever price it opened at, or whatever the previous peak was that led to the harsh winter, I know mathematically that I'm going to have a 2 or 3 to 1 R all the time, every day, without fail, because the harsh winter is such an extraordinarily large move down, according to our math definition, that I can fit a standard trade frame on a reversal of the trend. And I know that if this trend works and I end up getting an exit in here, I know that if it reverses and moves back up, I can get a re-entry with the COTA 2. But if that trade on the initial SSC fails, I know I can get a collapsing dragon before all of those trailing stops were hit from everybody that was aggressively getting long. Now, um, Richard asked me the question, how do I integrate and prioritize and look at all the indicators? What are the most successful? This is what I do. Here's my recipe, what I just said. We pick a population to consider. We run the criterion indicators on all of them to see which becomes preparable. We prioritize it based on reward to risk, and we trade them all, or we prepared to trade them all because they're all tradable, because it's a compound critical state. And then we go through a pattern procedure in the morning, starting with the biggest gappers, and then the harsh winters for the SSC. And then if it gets very, very quiet after things slow down at lunchtime, the point where all the directionality is gone, I start looking for the Z3 lines to pinch so that they are tightly squeezed. So now I have an intraday breakout box that can go favorably in either direction for a favorable reward to risk. And that's what we mean by the Z3 pinch and the super pinch. Now, if you wanted to draw a neat, nice, precise picture of that, well, it would probably look like this from back in the day when we first invented this. You have a harsh winter that reverses, crosses the baby dragon, crosses the dragon, leaves the dragon, the PSAR flips, you get a successful trade, and right in here, it's either going to collapse or it's going to reverse for a COTA 2. That's your SSC. With a little more precision, my impressionistic paint, there's my harsh winter, the harsher the better. Here's the first alert. It crosses the baby dragon, enters the dragon, leaves the dragon. Here's where the PSAR will flip to. There's my risk box. I'm looking for a return to some reasonable price level. And if I can get 1, 2, 3 to 1, that would be excellent. Somewhere in the movement of this favorable move, psychologically, I need to get my stop from the initial risk up to what we call no lose plus dinner for two, so that I can lock in the gains from my entry to this level. And the reason we brief and teach that is because that decision point to move you to no lose plus dinner for two means that the worst thing that ever happens to you is that you're going to win $100 and you can take your wife to dinner or your spouse to dinner or your partner to dinner. And if that's the worst thing that happens to you all day, that's a pretty good day at work. And so the psychological state of mind that you're in when you are able to make the first move to no lose plus dinner for two now allows you to treat the rest of the movement dispassionately. I know that once I get past an average win, that I should not let that thing come all the way back. And so I'm looking for, where did I get my 2-to-1 execution risk and 3-to-1, so that I can start activating a more aggressive exit strategy that allows me to preserve more of the open gain on an above average win. So we teach you how to think about management of the position based on the statistical performance that lets you distinguish between normal trading and above average wins. That's an important professional skill that gives us the ability to manage trades according to rules dispassionately. Oh, here's an example from today. We knew today was going to be a compound critical state because of trade location and all the rules. Plus, it's a Fed day. Every Fed day is a compound critical state. This is treasuries. For those of you that trade treasuries and the futures on the treasuries, we can trade the ETF with that size of a standard risk box, which is about 20 cents on $100 exchange traded fund for TLT. And here's where it closed yesterday. Oh, it didn't close here. In the last 10 minutes of the day, it went from this extreme sideways quiet channel, and then there was a ton of volume purchased in the last 10 minutes. Now, I'm not a conspiracy theorist, so there's no way that I would attribute that to people that knew what the Fed was going to say and then put positions in at the last minute so they could take advantage of what was going to be shadow net leakage of the Fed notes and the aftermarket trading that caused it to gap that high. I would never say that because I don't believe that kind of stuff goes on. But if it did, that's exactly what it would look like. But what I do know is that it moved from here all the way up to this opening, and then the opening range three, and this is all 3-minute bars, that's the opening range three, and then price continued through the top of that, which triggered the OR3 entry technique we teach, and it moved in an uninterrupted fashion to here when the RL10 rolled over, which means that we activate the exit at the skin of the dragon, which is the 10-period Bollinger Band plus or minus half a standard deviation, and on this much risk, in 30 minutes, we achieved a 3R win and were never underwater at any time. Routine trade. Now, it sold off from the peak of the RL10 through the volume weighted average price, which is a key price level all day because of math, and it reversed right here, which is right near where it opened. That's the least surprising thing. And this is where that R10 reversed, and that's where the Bollinger Band 30 simple moving average is, and the R10 crossed through the dragon, so we're able to re-enter that position with a TATA 2 entry, with a standard risk box, and with an initial risk located here, and it moved through the VWAP to the peak, and then we exited here at no lose plus dinner for two so that we could lock in that much gain against that much risk. And as we were starting to approach the Fed announcement, that's all we did. And in that first session from 9:30 to 11:30 in 2 hours, we produced 3.5 R on one target, CLT, standard normal work. Now, for advanced students that want to trade with the sniper, you can use those same patterns. And then when you get a Fed announcement that looks like this, and now I'm looking at 30-minute charts on SPY, this is why I like to swing trade on 30-minute charts. The S&P in 10 days went from 471 to 491, which is plus $20 on a $400 stock. That's a 5% move in 10 days. And that was a hugely tradable move. And there was a Z3 pinch. And when it broke out, we got this move. And today, because we are prepared for a breakout of this box, we initially got long here on this breakout. It failed, and so we ended up taking a fractional win. And when it fell out the bottom, we got short here on the intraday move, sold down or covered down here. And on this much risk, we got 1, 2, 3, 4R in 45 minutes plus 1R. That's 5R plus 3.5R on TLT, and trading the two biggest, fattest indexes of all. There's 8.5R on a Fed day. And everybody, you don't trade the Fed day because it's so crazy. No, it's not. It's just a volatility move that can be traded with standard work for volatile moves. And it turns out that the use of the sniper trading strategy and mindset and psychology gives you the tools for how to trade abnormally large volatility events in the same way that you trade them when it starts off in a quiet mode and then slowly breaks out and gathers steam. How you trade that volatility is exactly the same way you trade. Same tools, same setup, same mindset, same psychology, same risk management. And that's why the sniper trade is a system for all seasons, because you don't have to trade when the market is closed. You can trade intraday, and then when the market is closed is when you're doing all your planning and prep and your setup and your rehearsals, so that when the market gaps big in some symbols, you can start trading the volatile movers right now, every day. Standard work, no overnight risk, and some of them work so well that you could actually take some of the market's money and convert that to a swing trade. Why? Because swing trades are nothing more than a series of daily directional moves in one direction. And if you can trade intraday with day trading techniques and then preserve a little bit of that money, you can grow the day trade into a swing trade and convert that to a longer term swing trade into a core position, all with markets money, which is good news for your equity curve. That's everything that I want to say about the tactical sniper system, except to say that this one chart, which I will upload into the Owl Group course as a flashcard, gives you in one page the strategy, the key concepts, how we turn that into setups, how we take the setups and we answer the trade process questions, which we use for every system, not just the sniper. That's how fractally good that is. And that's the standard framing we use for every system, not just the sniper. That's how important that flashcard is. And then we use this little recipe card, describe the process by which we find the setups. And you don't have to trade all of them. You could start with the Godzilla and the fireworks, because those are the two best. And then you can prepare them in the same way, and you can trade them intraday in this logical sequence. You don't even have to trade the big gappers if you don't like the 3-minute bars. You could just wait and see which ones have failed the most and which have started to turn. And you don't have to trade all three of those patterns. You might say, I just want to focus on the kata 2. If you did, because you want a conservative but measured approach, you might be interested in the kata 2 challenge course, which Griff and Phil put together on the basis of me training Griff how to trade the kata 2 every day live for 9 months through COVID. and then beat him up until he got his rules and his teaching techniques down. And that's what the Kata 2 challenge is all about on their course. And I can vouch for the quality of that course. But you know enough today, if you're a trader, to be able to turn this page on your own into a system that'll work for you. If you want a fast track on that, that's what teaching is about. But I believe in telling you up front what matters. Those are the things that matter right there for sniper trading. That's everything I want to say. And in 3 minutes, we're going to be doing the nightly strategy podcast in this room. And so I'm going to exit the chat room right now so the recording can process and get uploaded in the usual spot. And then we'll be back in about probably 15 minutes to start the nightly strategy podcast with the regular crew. So take good care. Thanks for your kind attention. Thanks to Richard for a great question to prompt me with. And again, all of this stuff will get added to the workspace in the OWL group. Thanks very much, and we'll see some of you shortly. With 1 minute to spare, Griff, beat that.